Hi friends, welcome to my channel InfoCraze. In today's video, we are diving into some accounting basics which are very important for beginners in the field of finance and accounts. By the end of this video, you will have a fair idea on the basic activities involved in accounting. Before we proceed, please do not forget to show your support by hitting the like button and subscribing to my channel for more informative content like this. Now, let's get into the world of accounting together. Let's first answer the basic question, what is accounting? In a very simple way, accounting is the process of recording, summarizing, and analyzing financial information. If you look at the definition closely, key activities in accounting involve recording, summarizing, and analyzing of financial information. What is recording? Recording means documentation of every financial transaction. Summarizing, this means recorded transactions are organized into financial statements like income statement, balance sheet, and cash flow statement. Analyzing means summarized statements are analyzed in order to understand the performance or take decisions. Let's understand these key activities one by one. Recording. Every transaction which is measurable in money terms and affect the 5 elements of accounting are recorded. For example, purchasing an equipment for rupees 50,000 can be recorded, whereas a partnership agreement without any monetary value cannot be recorded. Now, what are the 5 elements of accounting that are to be recorded? Here are the 5 elements of accounting. Assets, liabilities, equity, revenue, and expenses. We will understand all these 5 elements of accounting one by one. Assets. These are the resources owned by a business or an individual which have economic value and can provide future benefits. For example, cash, inventory, buildings, or even a laptop bought for work. Then we have liabilities. Liabilities are the obligations or debts that a business or individual owes to others, like a loan taken from bank or credit card balance. Then we have equity. This represents the owner's claim or stake in the business after all liabilities have been paid off. For example, the money invested by an owner in the business. Finally, we have revenue and expenses. Revenue refers to the income earned by a business from its primary operations, such as selling goods or providing services. Revenue is a critical indicator of a business's performance and its ability to generate sales or income. Whereas expenses are the costs a business incurs to generate revenue and operate its activities. They represent the outflow of resources, typically money used to pay for goods and services necessary for running the business. Let's now see how these elements come together with a simple example. Imagine John starts a bakery with 1 lakh rupees of his own money. Thus, this will be the equity for the company. Thus, cash account, which is an asset, and capital, which is the equity, increases by rupees 1 lakh. As per the modern concept of journal entries that we have studied earlier, an increase in assets is debited and an increase in equity is credited. Thus, the accounting entry would be debit cash account rupees 1 lakh and credit capital account rupees 1 lakh. Then John takes a bank loan of rupees 50,000. This leads to the increase in cash account, which is an asset, and bank loan account, which is a liability, by rupees 50,000. Here the accounting entry would be debit cash account rupees 50,000 and credit bank loan account rupees 50,000. Subsequently, John buys an oven worth of 1,50,000 rupees using cash for his bakery. Thus, oven, which is an asset, increases and cash, which is also an asset, decreases by rupees 1,50,000. As an increase in assets is debited and a decrease in assets is credited, the accounting entry would be debit oven, that is the asset account, by rupees 1,50,000 and credit cash account rupees 1,50,000. Assume John earns rupees 40,000 revenue by selling cakes for a month. Thus, cash, which is an asset, increases by rupees 40,000 and revenue, which is an income, also increases by rupees 40,000. As per modern concept, an increase in assets is debited and an increase in revenue is credited. Thus, the accounting entry would be debit cash account rupees 40,000, credit revenue account rupees 40,000. Further, John spends rupees 20,000 on electricity. Thus, expenses account increases by rupees 20,000 and cash, which is an asset, decreases by rupees 20,000. As per modern concept, an increase in expenses is debited and a decrease in assets is credited. Thus, the accounting entry would be debit expenses account rupees 20,000 and credit cash account rupees 20,000. Hope you have understood all the accounting entries that we discussed here. You may refer to my earlier video on journal entries for better understanding, which is tagged at the end of this video. Thus, John will record all these financial transactions in his books through a process called bookkeeping. The recording follows the double entry system of accounting, where every transaction affects at least two accounts and finally summarized in the form of financial statements like the income statement, balance sheet, and cash flow statement. The entire process involves 7 sub-steps starting from receipt of source document to preparation of financial statements. I had made a detailed video on these steps named Basics of Accounting, which you can watch from the end screen of this video. Finally, the process moves to review, analysis, and interpretation of data, which help stakeholders understand the financial health of the business and take informed decisions. With this, we come to the end of this video. If you find this video useful, please like the same and share it with your friends. Also, subscribe to my channel for many such interesting videos. If you have any question, please put your query in the comment section. Thanks for watching.